Yeah.
get back after it. But anyway, let's just kick it off. And I'm happy that you're here. I like your feedback. I was shooting around some ideas in my head, and you kind of came back with the Cashflow Chronicles. I thought that was pretty
Yeah,
sweet.
because we're both always trying to figure out how to make more cash flow. I think the key to a good portfolio is just generating returns so that you can cash flow it back to more stuff, and then eventually retire with a
Yeah.
nice healthy stack. So we're chronicling our journey to generating more cash flow, basically.
Yeah, it's definitely. I mean, there's so many different ways too. Like you guys touch on a little bit on finance junkies, but I think there's a different avenue. I think some people on over there are more so on the speculative side and focus on that. And I think that there's another avenue, and Vitaly talks a bit about it as well, which is like the cash flow, the real estate side, the making sure that you're getting money, the lower risk, but also the things that pay the bills, sort of stuff. And I feel like I have a lot of it. That's where I kind of started off as, and I've kind of progressed over the past, I guess, 10 years or so as my portfolio's got a little bit better and sizable to be more balanced, I'd say. But
Yeah.
I've probably told you a million times about like originally I was doing kind of like penny stocks, had no idea what the hell was going on back like 10 years ago. And
Yeah.
then I didn't know how to manage my money. And then within about 6 months of me joining the workforce, I started seeing people get their heads chopped off. And so with that, I was just like, dividends are probably not that bad of a thing to invest in. But
to be fair, I was in the same boat as you, where I used to look at like the company stock and I would be like, wow, this company has like a 6% dividend. This is a great company, and I would completely ignore capital appreciation.
yeah, exactly.
And then I got into a zone where I only cared about capital appreciation and I completely ignored the dividend. And that was bad too, until I realized that there's actually times in the market where you can get both, where there's actually capital appreciation that can happen and dividend appreciation. What I mean by that is something like, let's say, Apple, right? Apple has, of course, always been growing their capital appreciation by doing share buybacks, but then they also have a dividend and they increase the dividend slowly. So even though it looks, when you initially buy it, it's like, oh man, I don't fucking care about a 1% dividend. That's today's prices.
Right.
If you were able to buy Apple in 2010, your yield on that same dollar is almost like 10%
Yeah,
right
I was gonna say
now.
probably 8% or something like that. You said
Yeah.
slowly. You said they raise it slowly. They don't, man. I mean, there's been years where they raise it 50% year over year. That was
Yeah.
probably more so when they first started paying a dividend. I would say it was probably within the last 10 to 12 years, like you stated. It wasn't too long after Jobs died, but that's where some of the love that I have for some of these stocks is. Like I bought BHP back in 2014, 2015. It was one of the first stocks I ever bought. And the yield on cost on that thing is in the 20-ish percent. And then there's some years where they've sold off some of their petroleum assets where you get a special dividend, and years where their cash flow is really high where they give a special dividend. There's been years where the yield that particular year is over 30% on cost. And so I'm sitting on like a 350% gain just on that. And I've had it for less than 10 years. And I'm like, I'm never going to sell this thing. Why would I ever sell it? I mean, it pays a 6 to 8% dividend in my Roth. So it's like, it just doesn't make any sense. But anyway.
One thing I missed? There's two stocks that I missed and I really kicked myself for it. One of them was in coal. So I think a lot of people is probably saying right now, Chris, coal? Like, who the fuck uses coal right now, right? But let me show you. I was on a flight with a friend who routinely travels around the same time. So let me hold on. Alliance Resource Partners. Okay. Let me just share the screen with you. So this was at the height of COVID. And I'm like, me and him were just going back and forth talking about like the market and stuff. So he said, look, man, I'll give you the inside track on this company. He said, this is coal company. And I said, look, man, I don't want to invest in a dead stock or a dead company. He's like, just trust me. It's a good company. They have a great balance sheet. Their dividend is really good. Financials are amazing. And they primarily have metallurgical coal. You won't have to worry about anything. I just want to show you real quick. Ooh. This was trading at freaking $3, okay, during COVID, like at the height, okay. $2, $3. That shit jumped all the way to almost 20 something dollars, right? Look at their dividend yield at this price.
Yeah, Jesus,
Okay.
14.
So imagine right now this dividend history. So at $3, you were getting a dividend of right here. Let's see, 2019, 2021 when they restarted it. Okay.
40 cents.
So
Yeah,
40 cents, like roughly. And right now it's almost 70 cents a quarter. So if you had bought a $3 stock and got a 70 cents dividend per fucking quarter,
yeah, man.
that means that's a 90% cash flow yield. And what's really shocking though is if you go to like their financials right now, it's very well covered from cash flows. Look at this. In net income, 200 million in net income. Revenue is pretty much stable, right? Operating income almost 205 in operating income. The PE on this I think is like 2. Look at this. No, a 3. Sorry, a 3. It's a $2 billion
I think a
company.
lot of really intelligent. So I think the writing was on the wall, I think, with what happened during the pandemic for a lot of natural resource companies, like oil companies,
Yeah.
mining companies, where they were just piling on so much debt. And I think that when the crap hit the fan in 2020, and it was like a commodities issue with respect to oil prices, copper prices, all the metal prices, I think they all realized like, oh crap, if we're going to survive this, like we got to pay down debt long term. We got to be more sustaining because eventually interest rates are going to go up. And I think that that's where a lot of those places have really been in the past few years. But you said something I liked really early on, because this is something with this particular show, whether or not, how long this goes on, hopefully forever. But the thing that I want to talk to people about, and I get on people as well, because when I first started, just like you mentioned, all I cared about was dividend income. And I was like 23 years old, 24 years old. It's like, what do you care about dividend income right then and there at 23, 24 years old? And it's like, I didn't care about capital appreciation. I didn't care about capital preservation. I was looking for the best companies, yield traps, 11%, 12%. And I didn't give a shit because I wasn't intelligent enough. I didn't really understand. I didn't have that experience about people cutting dividends. So I was investing in like gas royalty trusts, anything that would pay an absurd amount of dividends. And I see that going a lot on FinTwit, where people will just blindly go into something thinking that the yield is great. And I don't want to steer people away from it, but at the same time, I just wish that somebody shook me earlier. And there were a few people that were like, you should just invest in indices. But I do what I do because it's very much a hobby for me. But I try to poke in for people, and I don't want to call out any names, but there's a few people that I give a lot of crap to, where they're pretty much just like dividends at all costs. And while I do love the cash flow aspect of things, it was one of those things, like hopefully people get this over time. I'm not against dividend income or anything like that, but to me, I don't need 50 grand a year in dividend income at the moment. I'll probably get back to that point, but it was getting to the point 3 or 4 years ago where I was like, okay, I'm going to start making 20 grand a year in dividend income. And I'm like, I could keep that snowball going, try to get my portfolio yielding 5-6% to the point now where I'd be making, more than the average American salary in dividends. But I'm like, to me, I think it's more prudent to try to do the capital appreciation and have that balance. And so I think it all just depends on where you are in your perspective, your time horizon, all those things that we always talk about.
So for me, the mistake, I don't know, I was in the same boat where I completely ignored capital appreciation for a while. And then someone said to me, like, why are you going so much into dividends? Like, why not just buy the stocks that keep reinvesting in their own business? I'm like, well, what if I need the money? What if I want to buy a car? Like if I have dividends, I could stack those dividends and buy a car and then make payments using that. He's like, or you could just sell one share of whatever your stupid company that you have. And it's just, that's it. It's like, wait a second, you're absolutely right. I only have to sell one share, 2 shares, and make my monthly mortgage payment. Like think about that. If you had bought companies like Google, Apple, Amazon, whatever, when they were like at a much lower pace, yeah, sure, some of them don't offer a dividend, but the capital appreciation and like, let's say you needed liquidity, you just sell a few shares. That's it. And I know people right now, that's what they'll do. And that's a smart move where instead of focusing on dividends, what they'll do is they'll have their day to day income going directly from their checking. And then once they're done with their monthly expenses, any excess goes into like the index funds, right? But then, like, let's say if they have like a major like life event or anything like that, and they need to have the liquidity, they'll just sell a little bit of it. And
Yeah.
there you go. Boom. You got the liquidity right there. So it's a very interesting concept. But there are different ways to skin a cat. The one thing I will say though with investing, I think sometimes there's margins of safety where once you get to a certain age, you and your tax bracket. That's the other thing too, right? When it comes to dividends, if it's ordinary income versus qualified dividends versus interest payments, you can have like, oh, I'm yielding a 7% return. This is great. Yeah, but then you have to pay taxes on it, and you may be in a much higher tax bracket, and
You
you end
might be
up getting.
effectively getting a 4% yield at the end of the day.
Yeah.
Yeah.
Yeah. And that's happened to me too, where I was stupid with that. Where at the end of the year, I'd end up having to pay the taxes because let's say I bought a REIT and now I have to pay all this extra income in REITs. It's not good. Whereas the other side, if I just had it for capital appreciation, I would have don't have to pay shit. All I would have had to do is pay long-term capital gains on any stock that I sold to maintain my lifestyle. So it's like it's things like this I'm hoping that we get to talk about and we learn. And today's conversation is of course Google Cloud to zero. For anyone that doesn't know, Matt typically he has this joke where anything that he has, he usually just says XYZ to zero
It's
because
going to zero, man.
everyone is just so fucking bearish at times. So Matt just plays into it. Like, yeah, you're right. Fuck it. Blah, blah, blah to zero.
Going to
It's
zero, man.
sarcasm. It's sarcasm. Google, of course, is not going to zero. I don't think it'll ever get to zero. What do you think about their earnings today?
I was impressed. I'm a shareholder. I have 300. I forget which. I always get it mixed up. I have Amazon and Google as probably the big techs that I have. One has 380 shares. One has 360 shares. So they're both pretty sizable positions. They could be bigger, but most of the time I just like to invest in the SPY. But I was pretty excited because my cost basis on my Google shares is like 95 or $98, something like that.
Mm-hmm.
So I'm pretty excited about it. But the thing that blew up at me in a positive note was the cash flow from operations being over 50 billion for the first half of the year. I mean, they're going to hopefully close out the year close to $100 billion in cash flow. And you're just like, well, what are you going to do with all that damn money? Well, this quarter they bought like this quarter they bought like or the first half of the year they bought like 29 million or $29 billion in shares.
Dude,
granted, they gave out $5 billion in share-based compensation, but that's still a $25 billion net purchase on a $1.6 trillion company. So it eats away over time. So,
dude, Google is a freaking ATM, bro. They literally they are an ATM. I've never seen a more structured cash flow machine, with the exception of maybe Meta. They're just generate a ton of cash flow. So I think right now they're still very undervalued compared to a lot of the other fangs that are out there. So people who are looking at the price and saying, oh, I missed the run up. I don't think you missed the run up. It's just your time horizon has to be a little bit more forward looking. But, can you have timed it and got in the 80s? Yeah, maybe. But, not everyone can time it. So I would say right now, this would be Google, in my opinion, is definitely one of the more underappreciated Fang names. And I think it has a long way to run up the next like 6 months. I think we could theoretically see Google trading at like all-time highs again relatively soon and starting to beat all-time highs because of their sheer number of deals that they were making with AI based cloud. That's the other thing. A lot of people don't realize how big of a player Google is when it comes to AI.
right.
People think they're on like the back foot of things. And I don't think they're on the back foot. I think what it is they were just very conservative with how they approached AI to the point where Microsoft and OpenAI were just like, fuck it. Who gives a shit? Let's put it out there in the world. And it's, when you have the first to market mover advantage, it's really hot. It's really hard to get around it. So Google is actually the one that released the Transformer paper that all this other stuff is based on. So I would not put Google in I would not put I wouldn't I really wouldn't say the days of Google's what do you call it? Google's best days are behind it. I think that Google's best days are actually ahead of it. You know.
I would agree. I mean, you and I talked about this at length when the Q1 earnings came out.
Yeah.
So keep in mind the cloud revenue just went break even in Q1, and then if I remember correctly, it came out today, and I think the net income for Google Cloud was like 800 or so
Hmm.
million.
Yep.
So let me just pull it up here. Did I miss it? Yeah. I'm wrong, 395. But
Yeah.
it's starting to get, that's doubling pretty quick. So that's going from what, 191 to 395. So I mean, you're getting to a place where I think you're going to start to truly see that earnings hit the bottom line, very similar
Hmm.
to what happened with Microsoft in 2016-ish timeframe. Um,
Yep.
where things truly started to kind of take off for them, and people were like, at that point everyone was like, Microsoft is dead, they don't really have anything, they have their Office products. At that point nobody really envisioned Office 365, nobody really envisioned Azure, unless you were really focusing
Hmm.
on what Satya Nadella was doing before he took over from Ballmer. But I
Yep.
think that everybody was kind of getting to a place where they were kind of writing off Microsoft compared to Apple, and saying, well, Apple's going to be the clear takeover.
Hmm.
But going back towards what Google is, I'll let you kind of explain what you kind of have on
Yeah.
the slide here. This is a great graphic. Who made this?
There's someone from App Economy
Okay.
Insights. Like they're like they just like post the ones, those I forgot what they're called, like the pipeline charts that go into like shows you where all the income is actually going. I forgot what the term for that thing is, but basically you can see here Apple's I mean not Apple, Google's revenue from cloud has been growing, and finally now they're starting to eke out profit, you know, and this is a linear graph going this way. Dude, they're still in their infancy in
Yep.
terms of where they're trying to get to, and now they're actually profitable. This is going to be a major business for them going into the future. Just don't think about this company now. Think about how big this company's cloud business is going to be by 2030. And that scale is going to translate into huge shareholder returns. And this is a company that's already generating a ton of cash flow. If
Yep.
there's one company that you want to hold for the next 5 to 10 years, it's goddamn Google.
Yeah.
So
I'm with you there.
if combination of share buybacks, combination, like I said, it's just a cash flow machine. I don't even know why we're explaining. If I was a hedge fund right now, bro, this is like the easiest thing portfolio wise that I could allocate to. 10% Google, that's it. Let's not even fucking look at this for the next 10 years, you
Yeah.
know.
Well, I'm curious. I know we were joking about the Google Cloud part to zero, but were you pretty intrigued to see that the Google search kind of kicked up as well from Q1 or from Q2 last year? Because I think
No,
some
I,
people
I
think that the search business is in trouble.
dude, I tried using Bing for like a month, and let me tell you, after the first week I quit. I don't know what it is. It sucks. Bing is horrible. I didn't like the experience. The UI looks like garbage. You type in something, the sometimes it's correct, but most of the times it's not. It's so busy looking. I don't know what it is about Google indexing, but I don't think I've ever clicked on Google page 2.
Yeah,
You know.
it's definitely got staying power. I never
Yeah.
forget. I'm back when Google kind of first came out, early 2000s. I remember people were using Yahoo or Ask Jeeves, Bing, not Bing, Ask Jeeves, some other random
Mhm.
stuff, and then it's
Lycos.
yeah, it's
Lycos.
just things have just like the brand power of Google has really just taken over. Because I remember moving from Internet Explorer to Mozilla Firefox around the same time, and then
Mhm.
once I started using Chrome, it was just game over for that. So you have the market
Yeah.
share in that. You have Android. You have just the Google search engine itself. It's just been a complete powerhouse, and I think it is yet to really. I mean, I know people are in the chat talking about how they said AI a billion times. I don't even think we've even begun to see the benefits of AI. And you have to think, like, I don't think people really realize this. Is like OpenAI was kind of a brainchild of uh, Elon and some of the other guys in Google, and then eventually it
Mhm.
kind of got remorphed into what it is today. But I think Elon said it really good, and I forget what interview he said, but it was on a Tesla factory floor. Because like at one point, Google had like 85 or 90% of the AI capability in the world, and I think that there's truly still that power within Google. It's just you
Yeah.
have to have a reason to unleash it
Yeah.
at some point. Anyway,
I think AI is still I think AI is still a buzzword because the number of use cases is still very limited, right? The thing is though with Google AI Cloud, that's what it pretty much enables people to do. Where it's like, okay, here's Google AI, here's the Google AI Cloud. Now go crazy with it. Do whatever you want. Like, put developers who can create software and everything else using Google AI Cloud. And so what happens is it's almost like a toll bridge, right? The business is not like trying to develop a specific product for clients. This is like a toll bridge that everyone is going to have to cross. Amazon is going to do the same thing. Microsoft is already doing it. So what's happening now is you have Amazon, Microsoft, and now Google creating more toll bridges that everyone is going to have to walk over in order to get from point A to point B. And they're going to be collecting tolls the entire way. Now, does it mean that maybe Apple will collect Microsoft will collect some more tolls some quarters and Google will collect more tolls some quarters? Absolutely. The difference between Microsoft and Google right now, though, is that Microsoft tolls are accounted for already. Google's are not. Everyone already knows that Azure is going to make money. Google's was like, oh, Google AI Cloud, Google Cloud is like number 3. They're like there, but they're not really making money. Completely out the door now. That theory is completely gone. And now you're going to see an exponential amount of cash flow coming off the business. Once again, you already have a high cash flow business with your search. Now you're going to have this second high cash flow again. So it's like, this is what you want to be. The first conversation of Cashflow Chronicles, buy Google. If there's any other company that you have right now that's like super shady and risky and that you're worried like, hey, if a recession comes, what am I going to do? Google is goddamn recession proof.
mm-hmm.
Like no one is not going to use Google because there's a recession. Everyone is still going to be searching for stuff. Everyone is still going to be advertising on Google, and that Google has the capital to back a shit ton of projects out there. That's So I would say right now, if you're worried and you want to high class your portfolio, because that's what I'm doing. I'm taking some of my more speculative names that I have, selling them off, some of them at a loss because if I had lost money, whatever. Instead, taking that money, buying Google with it. And Google is like the anchor to my portfolio for the next 5 years or 10 years. I don't know about you, how you feel about that.
I love it, man. I mean, like I said, out of the big tech companies, I wouldn't even consider Amazon. Amazon's kind of like 50-50, right? Because they have the AWS side, which is tech, and then they have the e-commerce side, which you can kind of consider consumer goods, whatever. I consider it kind of a both because you do have the website aspect of it with the e-commerce. So it is both. But if you consider Amazon tech, I also have a big portion of that. And then I also am bullish on TQQQ for long holds, but that's a different story for a different day. That's speculative. Yeah. I don't recommend anybody buy that and hold it long term. And I got burned in 2022 holding that. So we can talk about that at a different time. But I love it, man. I just look at the first half numbers. I said it at the top of the show. I mean, 50 odd billion in cash flow from operations, 13 billion in capex.
And by the way, buybacks. Guys in the chat, if you think that tomorrow, like, oh my God, I missed out on the gains, dude, Google's got way further to go than you would believe right now. Okay. If you're waiting for a pullback, I don't think you're going to get one. I'm sorry. Whatever pullback you thought you were going to get,
$80 was it. $80, was it. And I don't think a lot of people are recognizing that. I knew a friend that unfortunately sold. He had hundreds of thousands. I think he had over 200 grand worth, and he sold. I was like, dumb move. I was like, I'm buying more. He's like, you are? And I was like, yeah, of course. Why wouldn't you? You have the opportunity to buy this thing. And I looking at the trends, looking how long cloud still has to go. And I guarantee, I shouldn't guarantee, but I'm fairly confident. And then 5 to 10 years time frame, you will see Google's cloud revenue be similar to what Amazon's is today. And if you look at what Amazon's net income is coming off of their cloud business, you're going to be sitting here in 5 years and being like, oh crap, right? Like
Yeah.
we definitely had a lot longer of a runway in cloud than I thought. Where Amazon's will be, and to keep in mind, I think Amazon's cloud revenue trailing 12 months is like 80 billion. So
Hmm.
if you kind of forecast out what that means for Google's, it's like 30, 32 billion if it kind of keeps at this $8 billion run rate, which I think it is per quarter.
Yeah.
So they're about 40, 35% of what Amazon's is at. I think that in 5, 10 years, it'll definitely be where Amazon's is at. So,
Yep.
anyway, but I think I'm looking forward to the share buybacks and seeing how that impacts it. And I did another analysis and looking at the cash flow from Microsoft versus Google, and they both made about 28 billion in cash flow from operations this quarter. Microsoft is a $2.6 trillion company versus Google's a 1.6. I honestly
Yeah.
think that Microsoft is very expensive right now.
Yeah.
And Google is slightly undervalued compared to where it normally sits in terms of
Hmm.
valuation. But so I think they could meet in the middle and everything would kind of
Yeah.
be okay. But anyway, it was just an interesting kind of endeavor to look at that. But I want to get, because we always talk about or at least when I listen to Finance Junkies, we
Hmm.
always talk about your speculative portfolio, and you're kind of talking about, all right, well, I want to look a little bit more at my long-term portfolio. I'm very curious. I'm more than happy to share what my big positions are for dividend income and what
Hmm.
I look for future appreciation in that respect, or
Yeah.
capital or dividend appreciation in that respect. I'm curious, opening the window to Chris's long-term portfolio.
Hmm.
What are your favorite guys
Okay, so I actually posted this on
on
my
your Patreon?
Patreon. Yeah, and I'll tell you guys what it is. So, and I'll show you the allocations that I've made to each one
Yeah,
as
I got to be
well.
sure to put your Patreon in the link.
No, it's all right. Yeah. So basically, let me just pull it up real quick. Uh, so I shared it with everyone, and I called it the beginner portfolio right now because like a lot of people they just started with my Patreon, so I wanted to kind of explain things. But these are the companies that I have. So I have 20% in VT, which is the
Okay.
total world index, right?
Yeah,
I know some
Vanguard.
people want to do just the US. That's fine too. Me right now, emerging markets need to catch up, so I wanted to get a little bit more exposure to the rest of the world.
And I
So I
think it has
have
a little bit
VT.
better dividend income as well than VTI. So
Yeah, yeah, it has like a 2% dividend, you know. Then you have Google, which is my next biggest position, which is 10% of my total portfolio. Amazon is another 10% of my portfolio. Then I have SLG, which everyone loves. It's another 10%. That one is a play on capital appreciation because they're trading below book value from the assets that are actually worth in New York City. They're class A buildings that are cash flowing, great leadership, great management, and they're actually very conscious of the dividend that they have, their dividend income. So they want to make sure that they maintain that. They actually even said the last quarter. So I was like, great. It's an easy thing. I had it since I was like since it was in the 20s. So I'm holding on to SLG. Another one is TFC. That's another 10% of my portfolio. Truist. Truist once again underrated bank, trading way below book value, trading below in terms of PE from what it's supposed to be for the industry average historically. Historically, regional banks have traded like between 10 and 12 PEs. Right now, I think it's trading at a 6 PE. So it's got a pretty much a double on its way. And that's what my market value assumption is. And it pays a dividend also about a 6% dividend based on today's pricing. Um, then I have PayPal, which is my more speculative name. That one is about 5% of my portfolio. That one is playing on fintech recoveries and share buybacks. I think the business, they realize that they overinvested in certain things. So they're doing a lot of buybacks. They're free cash flow positive, which gives them a lot of flexibility to increase that. And the share price is so depressed right now. I think it's trading at 2018 levels. So I figured that those share buybacks plus the cost reductions in personnel will eventually make its way down to its cash flows. And then once again, that'll help them increase their buybacks. Then there's KeyBank, Comerica, Zion, and Regions Financial. Those are all regional banks that, once again, they're cash flowing banks. they're more selective in their region. And what I wanted to do was diversify away from just one regional bank. I wanted to kind of get more exposure, but they're all trading way below their book values. They've got good dividends. And so I'm looking at from a capital appreciation standpoint, those companies. So this way, I think their stocks could actually double from where they are today. After that, I have Wingstop. I know people are going to laugh
Great
like
choice.
Wingstop.
Yeah.
Wingstop.
Well, how long have you
Everywhere
been
I
holding
go,
it?
for like the last 6 months. So
Okay.
I haven't done like super well on Wingstop. Wingstop has like expansion plans that go way beyond just the
Yeah.
United States.
Huge international ambitions.
Yeah, they have huge international ambitions. Their operating model is really, really light. So basically, anyone can get started with a Wingstop franchise. It's not like super complicated. All it is you get wings, you put them in the fryer, you fryolate them. They have all their secret special sauces. And they just toss them in there, and boom, there you go. You've got a ready-made meal. And every time I go, it's like crazy. Like people constantly, especially with Uber Eats crowds, they love Wingstop.
Yep.
By the way,
It's
I don't know if you know
definitely one that I go for with Uber Eats, especially on Tuesdays, and they generally have a pretty good
69 cent boneless wings.
Yeah,
That's what I
something like
usually
that.
get too.
Yeah.
Do you know that Rick Ross owns like 20 of them or something like that?
Not dumb either. I think that's really smart and a really good way for him to kind of just like park money.
Yep.
Super smart.
Another company that's recently come on my radar that I've allocated about 5% is it's called Atcore. I don't know if you've ever heard of them before.
No.
Maybe we'll save that for another episode. But basically, the ticker symbol is ATKR. They are and this is
That's one you messaged me about the other day.
Yeah. So basically, they do electrical conduits, and I know that's like electrical conduits. Why the hell would someone invest in that? Like, oh, you'll see. And my last one is Disney. Disney, I feel like, is a turnaround story that's just beginning to happen, and I think we're going to see a massive turnaround in Disney, and I want to be there for it. So that's my concentrated like portfolio. I have another portfolio that's just very like out there with like different things, but those are like my main positions right now.
Disney's one that I held, and I regret not selling when it hit the 190 or so. For some reason, when it hit $190, so I've been holding it for a while. So I'm either slightly down on my position over the past 5-6 years or slightly above. It's not anything of a barn burner, but when it hit 190, 200, I think it was with the hype of what was going on during the pandemic with streaming services and the price did really, really well. I regret not selling back then. But I think that there's still like a lot of people are counting it out. They're like, oh, it's just a drag on earnings right now. And I'm like, you have to realize you have to get the market share before you up the prices, right? Yeah. Just like Netflix. Netflix is now getting to the point where they're starting to get to the saturation point. So now they can raise it by $1 or $2, and they don't mind taking the hit of, say, 5% of their clientele or what have you, because their cost basis is taken care of. Their net margins are going to go through the roof as long as they continue to make sure that they do it slowly over time. And I think Disney's in that place where they're trying to sell it super cheap, like $4 or $5 in some countries, to just get that market share. And they have that catalog worth of material, and they continue to buy it. They bought a bunch from Fox not too long ago. And anyway, I think that's something that's going to have a lot of staying power over time.
We'll do an episode about it because there's a lot of, so the post that I put on Twitter was that originally my goal was maybe I'll short Disney. Yeah. And when I looked at it, bro, there's no way in hell I'm shorting this company. All right. It's a multi-headed hydra with income coming in from all sorts of places. You could not imagine how many business segments these guys have. The difference is they don't break it out as like into like its own individual sections. So that's why you get lost. But dude, you're talking about toys, cruise lines, amusement parks, food, hotels, entertainment. You've got licensing of IP to like third-party consumers, third-party companies, right? I mean, they have a movie catalog, a music catalog. Like no one even considers those things, but those are residual incomes that are going to be coming into Disney, right? So I think a lot of times right now people are looking at Disney and just saying, oh, Disney's politically woke equals broke. And they're using that narrative, but they don't realize that like under the right leadership, Disney is going to be a cash flow monster in the next like 2-3 years. And that's just once again going to go right back into feeding their dividend, which they had suspended to make sure that they have decent cash flow. And even the debt that they took on during COVID to finance, like during, not during just COVID, but around right before COVID to finance their Fox deal, because that's what really got them into a lot of debt. That was like $70 billion of purchase, but it gave them like a lot of stuff. Did you know that they actually own majority stake in Hulu?
Yeah, there's 60%, or is
Yeah,
it up? Yeah,
60 or 75 almost. So,
yeah.
dude, it's Disney
That's
is
why
gonna be a
when
cash
I
flow
love
monster.
Amit, but when he started talking trash about Disney's streaming the other day, I
Yeah.
was just like, this. He doesn't have any idea as to how much ESPN Plus is up to like 25 million subscribers. He
Mm-hmm.
has so many different avenues in which they're. It's to the point where I was thinking about it, and maybe this is going too much in detail, but I was like, they're trying to sell ABC and a lot of those things. It's like, well, they don't give a shit about the networks; they care about the IP. So I'm like, I
Yeah.
get it when they just care about basically being able to put it on stream and get the high margin piece, which is the IP. They don't want to be
Yeah.
dealing with like the
So
talent and stuff like that.
so let me explain one thing, and this will be like a breadcrumb into our next episode eventually when it comes to Disney. Okay, Disney traditionally they have the best monetization engine in terms of that I've ever seen in my life. Okay, so what happens is they have IP, like let's say the movie Frozen. You have Frozen, it goes into the movie theaters, makes $1 billion, billion plus actually, almost made $2 billion. Next, after that, people buy toys from Frozen and all the other stuff, right?
And the
So now you're
ponies,
getting
all that
revenue
stuff.
from that. All that stuff, stickers, freaking Walmart is littered with this shit. So they're going to make money off of that. Okay. Then comes going into consumer digital. So basically, it gets put on like Amazon Prime, Google Play, the Apple Play Store. So basically, if you want to watch it at home, you can. So let's say you missed it in theaters, you can go to the other streaming thing and you can watch it at home if you want to, right? Then it goes into its Disney Plus category library so that this way it lives there and people can watch it. Then they have amusement parks that are centered around this shit. And now they're monetizing on that, right?
Mhm.
Then they'll do things like license out the IP for musicals and generate money from that. And this is revenue that's going to be coming in not 4 years, 5 years, for freaking the next 50 years to
Yeah.
100 years.
Yeah, look at Mickey
Like,
Mouse, right?
yeah.
And
Yeah.
how long ago? When's the last time you saw like? Well, I guess they have some of the Disney Plus cartoons that have Mickey Mouse and stuff like that, but
Yeah.
it's not like they've made a Mickey Mouse movie anytime recently.
Yeah.
Oh, super chat. There we go. I already have to owe Chris a bunch of money. But I do want to give a shout out to my boy Hot Dave. I haven't seen this guy in 6 months. My buddy, I don't want to give too much away, Chris, but I'll tell you about him maybe off stream. But this guy about a year ago retired and is living off of his income. He's in his 40s and he's doing relatively well. But I haven't seen Hot Dave in a minute, so I'm glad he was able to stop by. But yeah, man, there's so many, and the hope is, I really want to hope to provide something to the audience. It's a little bit different. It's a little bit less hype. It's more into the financials, the cash flow statements of a lot of these companies. And the thing that you brought up earlier, which is PayPal, really strikes a bell with me. PayPal used to be a heavy growth story, right? If you remember, probably like 5-10 years ago, it got spun out from eBay. Everybody was all hyped because it was growing way faster than eBay. So that's why they spun it off. And now it's getting to the point where, and all companies get this way at some point. It's getting to the point where the IP is mature, the business is matured, margins start to shrink. And so then you start looking at it and how those companies kickstart, they go through cycles. Hedge funds will buy into them. Hedge funds will sell out of them. And the thing that's beautiful about a lot of these dividend paying companies or just companies in general is you have people moving in and out. And with that, you'll see 20% cuts in the stock for no reason whatsoever other than just the ebbs and flows of the market. Some of it might be macroeconomic. Some of it might be the hedge funds moving in and out, a big player selling their position out, say 5% stake going into a different company. And so selling that obviously puts a huge depression on the price. That to me is where beauty is made. Caterpillar in
Yeah.
October 2019 was one of my best positions, and I sold it
Mhm.
probably 6 months to a year ago, where I was able to start picking up shares at a low hundreds for Caterpillar. And you
Mhm.
started getting into the 200s, and I'm like, I don't really see Caterpillar, going to $300 anytime soon. So I sold it and put my money elsewhere. But that was
Yeah.
so beautiful to get that opportunistic buy in the low
Yeah.
100s, where you're like, shit, this just came back from 150, 160. There's nothing wrong with Caterpillar. It might just be in a rut right now because it's
Yeah.
2019 and who knows what's going to happen. Next thing you know, you start getting the Inflation Reduction Acts, the Infrastructure Acts, all these things that
Mhm.
truly turn it around.
Yeah.
So there's a minute way to look at things other than hopefully not catching falling knives, because that's another piece
Yeah.
that some people get
Yep.
stuck with as well.
Yep. Well, I think we can end it here because I've been meaning to take a shit for the last 10
10
minutes,
years,
but
Jesus.
I've been patient. I'm like, I don't want to interrupt Matt, but I've really got to take a dump. So
Dude, you're good. You're good. You're good.
I'm gonna take a dump, bro. So thank you everyone for joining for the first episode of the Cashflow Chronicles. Hopefully we can show you guys how companies grow, how they can actually effectively use their cash flows to, one, pay us as shareholders, and two, maybe reinvest that cash into the business, or three, buy back some shares, in which case us as shareholders, we get rewarded. So
Cool.
essentially, this will be the start of something very brand new. We're going to be a little bit more detailed, like Matt said, in how we dissect companies, not just through the lens of hype, but also through the lens of numbers. And hopefully we can all profit together.
Yeah. The hope
Yeah.
is that this will be daily, if not multiple times a week. So we'll have to
Yeah.
feel it out. Chris might have to be late
Yeah.
at some point. I might have to be late at work at some point.
Yep.
It might be hourly. It might be 24/7. That's the goal. As long as Chris doesn't have to go to the bathroom, I think we'll be on
I gotta
24/7.
go. I'll see you
You're
guys.
good, brother.
Have a
You're
good one.
good. I'll talk to
Bye.
you later.